Welcome back to the Motivated Mind Zone. Glad to have you here.
Great to be back.
We are immediately pivoting today, moving from, motivation and mindset theory into something that, frankly, demands extreme mental discipline, focus, and, a huge amount of motivation. We're diving into the utterly jaw-dropping world of ultra-high growth stocks.
Right. High octane stuff.
Exactly. So if you, the listener, are here trying to figure out how investors spot these companies, the ones with maybe generational wealth building potential.
And crucially, how to survive the massive risks that come along for the ride.
Then you are absolutely in the right place today.
That's spot on.
Yeah.
We've really dug into our sources here, looking at these intense investments. And our mission really is to pull out the concrete facts for you.
Going beyond just the headlines.
Way beyond. We need to understand the specific business models, what's actually driving the
The
growth.
serious risks, too. Can't ignore those.
Definitely not. And maybe most importantly, the kind of mental strength, the fortitude, you need to actually hold on long enough to see the rewards.
And when we say high growth, we are talking about potentially history-making growth. Just to set the stage, let's throw out some historical 10-year return numbers that really define this whole category.
These are the kind of numbers that make your eyes water a bit.
They really do. We're talking about companies that manage to keep up strong double-digit revenue growth year in, year out.
Even when the wider economy was, doing whatever it was doing.
That consistency, as you said, seems to be the absolute key factor.
It is. So over the last decade alone,
Mm-hmm.
NVIDIA, up a staggering 31,000%.
31,000%. It's hard to even grasp.
It really is. AMD, a company we'll definitely dig into later, up 6,900%.
That's huge.
Massive. Shopify, 5,300%. And even the giants, right? The ones you think might be slowing down.
Like Amazon.
Amazon, 924%. Meta, formerly Facebook, 859%. Google, 831%.
These aren't just like good returns. These are the kind of returns that can literally define a portfolio for years.
Absolutely. Transformative returns.
And the common thread, like our sources keep hammering home, is that relentless double-digit revenue growth.
Year after year. But there's another layer too, acceleration.
Right. The sources pointed to Palantir as a great recent example of that. Their growth rate didn't just stay high, it actually sped up.
Yeah, it crept up from, 12%,
Mm-hmm.
then 16%, 20%, 30%.
And eventually peaked at 48% growth.
That accelerating momentum, that's where the magic happens. When growth starts compounding faster and faster, you get this incredible multiplier effect.
And the result for Palantir shareholders who held on through that.
Over 2,000% gains during that key period. It's just,
It illustrates the potential scale here. A small investment becomes comfortable, a medium one, serious wealth.
And for folks already well off, it can be the catalyst for generational shifts in wealth.
So that sets up our mission for you today. We're going to explore 5 current companies that our sources flag as these ultra-high growth plays. Businesses growing at, say, 20% plus consistently.
And we've got one honorable mention that's pretty intriguing too.
Okay. And for each, we'll detail their specific models, the growth drivers, the big risks to watch out for, and what their potential looks like over, say, the next 5 to 10 years.
Sounds good. But first, let's lay some groundwork, because this isn't just about picking the right stock.
Yeah.
It's maybe even more about understanding the rules you need to play by in this ultra-high growth game.
Good point. Let's start there. Okay. Rule number 1. The absolute non-negotiable prerequisite for owning these kinds of stocks.
I'm gonna guess. Volatility.
Exactly. The volatility warning. You, the investor, have to be mentally prepared for extreme major swings in price. It's not optional. It's fundamental.
It's probably the biggest psychological hurdle for most people. Look, our sources look back over 17 years of market data. Every single successful high-growth company, every single one that went on to make those huge returns went through dramatic corrections.
Not just small dips.
No, crashes. Periods where the price dropped 30%, 40%, even 60% or more. And every time, investors were asking, is it over? Is the growth story dead?
It's easy to panic in those moments.
Very easy. The sources use this great analogy, the ant on the waterfall.
Oh, okay, paint the picture.
Imagine you're the ant, the investor. You step onto this massive, powerful waterfall that's the inevitable volatility.
Right.
If you haven't prepared, if you don't have a long-term view, you're just going to get thrown off violently.
You'll sell out.
You will panic, and you will absolutely sell at the worst possible time,
Right.
right at the bottom. So if you're not mentally okay with watching your investment potentially get cut in half,
Yeah.
these aren't for you.
That mental preparation is crucial.
Yeah.
And it ties directly into the next point, doesn't it? Valuation.
It does, because people look at these stocks and immediately say, whoa, that's expensive.
Yeah, the price tags look high, the PE ratios, the price to sales ratios, they're almost always higher than your average S&P 500 stock.
That's the classic pushback. The PE is too high. It's overvalued.
Maybe we should quickly define those terms for anyone new to this. PE is price to earnings.
Right. The stock price relative to the company's profits. A high PE means the market is betting big on future profits.
And PS is price to sales, so priced relative to the company's revenue. Same idea, betting on future growth.
And the rationale here is absolutely key to understanding this whole space.
Yeah.
You're not paying for today's value, which, yeah, might look expensive on paper.
You're betting on the future.
Exactly. You're betting the company will grow into that valuation over time. The idea is that today's high PE or PS will actually look cheap 5 years down the road.
Once the underlying revenue and profits have compounded and caught up.
Precisely. You're essentially paying a premium today for what you believe is a high degree of certainty about future growth.
Okay, that makes sense. And this brings us to another great analogy the sources used, the F1 car versus the Honda Civic.
Love this one. It really clarifies the risk and the premium pricing.
So the Honda Civic, that's your average stock, right?
Yeah, think of it like your typical maybe diversified ETF or a solid blue chip stock. It's relatively cheap, reliable, gets you from point A to point B.
Does its job perfectly fine for a lot of investors.
Really fine. Predictable, reliable.
But the ultra-high growth stock, the kind we're talking about today.
That's the F1 car.
Okay.
It's built for very specific, very special things. You can, take a corner at 100 miles per hour. It delivers performance like those 31,000% returns that go way beyond just point A to point B.
But you can't expect the Civic to do that.
Nope. And crucially, you can't expect the F1 car to be priced like the Civic.
Ah, right. The premium makes sense in that context.
The premium is warranted by the extreme potential. But, and this is the big but, that performance requires intense skill to handle, specialized maintenance, and, a much higher risk of a crash. A much higher risk of a catastrophic crash if things go wrong or if you don't handle it right.
Okay, that really sets the mental framework we need. Let's start applying this. Let's detail some of these specific F1 cars, starting in the consumer space, brand and distribution driving growth. All right, stock number 1, Celsius Holdings. Performance, incredible, up over 700% in the last 5 years.
Phenomenal run.
Yeah.
But let's immediately link that back to the mental cost, right?
Good point. To get that 700%, you had to ride out numerous, absolutely vicious volatility cycles.
We're talking major drops, 20%, 30%, 40%, even 50% down. Multiple times.
It really is the definition of high reward, high volatility.
It is. So Celsius, they carved out a space as a major energy drink player. Their big success was tying the brand very strongly to fitness gym culture.
That helped them stand out from the big guys?
Yeah, it gave them a niche to cut through the noise from, Red Bull and Monster.
And their expansion strategy seems critical. Acquisitions and partnerships are key here.
Very much so. They recently bought Alani, another energy drink popular in the fitness world.
Similar niche then.
Similar, but the important detail our sources highlight is the demographic focus. Alani specifically targets women more heavily.
Ah, So that immediately broadens Celsius's potential customer base, takes them beyond their original, maybe more male-focused core.
Exactly. Smart move. They also acquired Rockstar from Pepsi.
Rockstar's market share isn't huge, though, is it?
No, it's pretty low right now. Competes directly with Red Bull and Monster. But the strategic play there wasn't just about the Rockstar brand itself.
It was about the Pepsi relationship.
Bingo. It was about cementing that distribution deal with Pepsi.
And that Pepsi deal seems to be the main growth engine everyone's focused on now.
It's huge. Pepsi is now a major investor in Celsius. And look, Pepsi didn't do this out of kindness. They needed a much stronger play in the energy drink category.
Especially as coffee drinks evolve and things shift.
Right. This whole thing mirrors what Coca-Cola did years ago with Monster Energy.
Coke bought a big stake in Monster, didn't they?
Yeah, about 19% ownership. It was a
Yeah.
win-win. Coke got easy exposure to the booming energy market.
And Monster got access to Coke's unbelievable distribution network.
Exactly. So for Celsius, this Pepsi deal means, boom, massive U.S. distribution is basically handed to them. And maybe even more importantly, for the next phase of growth.
International expansion.
Massive international expansion is now on the table, powered by Pepsi's global reach.
That seems like the big story for the next decade, then. Celsius couldn't possibly build that global network on its own quickly.
No way. Partnering with Pepsi lets them potentially replicate what Monster Energy did over the last 10 years. Monster's huge growth driver was breaking into international markets.
Makes sense. But they did hit a bump recently, didn't they? Shows how fragile these things can be.
Yeah, it's a good reminder. They had those amazing growth quarters, 104%, 94% revenue growth. Just incredible numbers.
But then
Then after the Pepsi deal kicked in around 2023, things got a bit messy temporarily.
what happened?
The sources called it an over-ordering, over-distribution situation. Basically, as the huge Pepsi system tried to rapidly scale up Celsius distribution, there were logistical hiccups. Too much product in some places, maybe not enough in others.
Leading to softer numbers?
Yeah, it led to a soft patch, a temporary dip in revenue growth down around 30%. And predictably,
Investors freaked out.
investors freaked out, treated it like the brand was suddenly failing.
But the rebound tells the real story.
Exactly. The latest quarter showed revenue growth bouncing back to 83%, which indicates, the big growth days are firmly back.
So the setback wasn't about the drink itself losing popularity. It was a scaling issue.
Logistics and scaling. So for long-term believers, the sources suggest the future international opportunity powered by Pepsi makes the current price potentially attractive.
Okay, let's talk risk, though. If everything hinges on Pepsi, what if that relationship goes sour? Or what if Pepsi decides, hey, we can make more money doing our own energy drink?
That's absolutely the core risk. Dependency on the distribution partner. And Celsius still has to fight tooth and nail against Red Bull and Monster, who have bottomless marketing budgets.
Plus, there's always the fad risk, right? Can they keep that fitness vibe as they go mainstream?
Or do they dilute the brand? These are the tricky corners that F1 car has to navigate perfectly. Hashtag 2.2 ELF Beauty Cosmetics.
All right, next up, ELF Beauty, another consumer stock that's just been on a tear. 551% return over 5 years.
Another amazing performer. And again, characterized by those brutal volatility spikes along the way. You had to have conviction.
So ELF, fascinating story in modern brand building, isn't it?
It really is. Super popular cosmetics brand, thrives on social media, Instagram, YouTube, and especially TikTok.
Their whole model seems built on 2 pillars, being cheap and being fast.
Exactly. The pricing is crucial. Most things are under $15. Tons of stuff under $10.
Makes it accessible for younger consumers who follow trends.
Yeah, they want frequent, low-cost updates based on what they see online. They're not necessarily loyal to expensive, old-school luxury brands.
And distribution. They seem to be everywhere already. Target, Walmart, Amazon, drugstores.
They are massive physical footprint. But here's the key insight from the sources. they're still considered under-distributed within those stores.
Wait, unpack that. How can you be in every Target and Walmart but still be under-distributed?
It's about shelf space. It means the retailers themselves, Target, Walmart, haven't yet fully allocated prime shelf real estate proportionate to ELF's growing market share and popularity.
Ah, so they have room to grow within the stores they're already in.
Exactly. Huge internal expansion opportunity over the next 5 years. They don't need new retail contracts. They just need the existing partners to give them more space as sales keep climbing. That's a really powerful low-cost growth lever.
And like Celsius, they're playing the acquisition game too. Seems like they're trying to be the next Estee Lauder.
That's the comparison the sources make. They bought Naturium in 2023, known for body washes, growing fast. But the really big news,
Hailey Bieber's brand, Rhode.
yeah, the recent acquisition of Rhode Skincare, which is apparently seeing, quote, insane growth rates.
There was a specific anecdote about the Rhode launch that really stood out.
Oh yeah, the Sephora launch numbers, just incredible.
Yeah.
Rhode reportedly did around $15 million in sales on its first day across North America. That was September 4th.
15 million in one day for a new brand launch in stores.
Astonishing.
Mm-hmm.
Apparently it set a new record for a celebrity brand retail debut. Beat out previous big launches like Rare Beauty from Selena Gomez and Fenty Beauty from Rihanna.
Wow.
And here's a detail that shows how they manage perception. Multiple Sephora locations in New York, like in Soho, reportedly sold out of Rhode products within hours.
Creating that must-have high-demand buzz.
Exactly. Even if some of that was due to maybe tight initial inventory, the perception it creates, this stuff is so hot it's flying off the shelves, is marketing gold. It just fuels more demand.
Yeah. Now, ELF itself had a couple of slower quarters recently, right? Like 3% and 9% growth.
Yeah, a bit sleepy. But the expectation now, fueled by the Rhode acquisition and continued momentum in the core ELF brand, is for, well, insane revenue growth is the phrase used, starting maybe even next quarter.
So the market's anticipating this.
Big time. Projections are floating around for the stock to hit $200 or more in the next 9 months, purely based on these expected growth rates kicking in.
And the long-term vision is clear. Keep acquiring hot brands, build a portfolio, become the next Estee Lauder.
That seems to be the playbook. Estee Lauder built its empire through smart acquisitions from the 80s through to, like, 2015.
Let's do the risk check here. For ELF, it seems like integration is a big one. Rhode is hot, but fitting it smoothly into a big company.
Takes time and skill.
Exactly.
The source mentioned they'll likely be focused on integrating Rhode for the next year, year and a half. Integration risk is real. You can buy a cool brand and then ruin it with bad management or trying to scale too fast.
And the other risk, fads.
Huge risk in cosmetics, especially fast fashion cosmetics. They live and die by social media trends. What's viral today is forgotten tomorrow. The ELF has to stay incredibly nimble, constantly churning out new, affordable products at lightning speed.
Okay, shifting gears now to the tech giants. And let's start with one that often gets maybe overlooked in the ultra-high growth conversation just because it's so massive. Meta.
Yeah, it's this interesting scale paradox, isn't it? Because Meta is just so enormous, people assume the hypergrowth days must be behind it.
But the numbers tell a different story.
They really do. The data shows Meta consistently churns out 20% plus revenue growth year after year. The latest quarter, 21.6% growth.
For a company that size, that's still beastly growth.
It's phenomenal. And their core engines are still firing on all cylinders. Facebook, Instagram, they're still growing. Instagram's ecosystem now reportedly serves 3 billion users.
3 billion! The scale is just mind-boggling.
Unprecedented reach. But the really exciting part for future growth, according to the sources, might not even be Instagram anymore.
It's WhatsApp.
It's WhatsApp. The sources emphasize it's still in the very early days in the monetization cycle.
So a huge user base that they haven't really started making serious money from yet.
Exactly. Massive untapped potential for revenue and profit growth over the next 5 years as they roll out more tools for businesses, communication, maybe even commerce within WhatsApp.
What else signals their confidence in the future, besides just the core apps?
They're spending
Huh.
their capital expenditures, or CapEx. Meta is pouring absolutely massive fortunes, billions and billions, into chips, data centers, the whole infrastructure.
That suggests they see something big coming down the pike.
It's what the sources call the Zuckerberg confidence principle. He's not authorizing $20 billion a quarter in CapEx unless he's extremely confident that the future payoff, 5 or 10 years out, will dwarf that investment.
Building the foundation for whatever comes next.
Right. The infrastructure for the next evolution of the internet, whether that's AI-driven or metaverse-related or something else.
And the innovation is happening across the board, needing all that spending. AI is obviously huge for them.
Huge. They're right at the forefront with their llama models. That's already improving their recommendation engines, making ads more relevant.
Which directly helps advertisers get better results.
And that means advertisers spend more. It's already showing an early payoff.
But it's not just software, is it? They're pushing hard on hardware, too.
Yeah, VR headsets are constantly evolving. And the wearables piece is interesting, too. They just launched those new Meta Ray-Ban AI glasses.
The ones with the display.
Yeah, the display glasses. Priced around $800, apparently have wrist gestures, other cutting-edge tech. It shows they're serious about owning the next computing platform beyond the phone.
Now, we have to talk about the historical view here, because this kind of aggressive spending, these big bets, they always attract skepticism, right? Zuckerberg's often painted as this gambler.
Oh, constantly. Think back to the acquisitions. Instagram for $1 billion.
People thought he was completely nuts, spending $1 billion on a photo app with almost no revenue back then.
And now, if Instagram were spun off today, it'd be one of the most valuable tech companies on the planet.
Then WhatsApp for $19 billion.
Same reaction. The market totally lost its collective mind over that price tag for a simple messaging app.
But now it's integrated, growing, and as you said, monetization is just beginning.
And even more recently, Threads, launched as the Twitter killer.
Mixed reception initially.
Yeah, but now it's reportedly up to over 300 million users, one of the top downloaded apps daily. The pattern seems clear. Meta makes huge long-term bets on future platforms and infrastructure,
They endure the short-term criticism, stomach the high capex.
aiming for long-term dominance. And at the end of the day, the core game for Meta hasn't really changed.
Keep users engaged longer.
Yep. Keep them scrolling, watching, interacting, show them relevant ads, make advertisers happy with their ROI so they spend more. That applies to consumers, B2C, and businesses, B2B, advertising on the platform.
Okay, let's break down those future projections from the sources. Give the listener the range of possibilities here.
Right. 3 scenarios based on analyst data. First, the bull case. This assumes things go really well, maybe even better than now. Average 20% revenue growth per year.
Leading to maybe 22% net income growth?
Yeah, something like that. If they hit that, the sources argue it justifies a premium PE ratio, say 35 to 45. That puts the stock price somewhere between $2,200 and $2,800 by 2029.
Wow, what kind of annual return is that?
That's a compound annual growth rate, CAGR, of 31% to 39%. Truly massive potential. The F1 car performing at its peak.
Okay, what about the middle ground, the base case?
More conservative. Assumes growth slows a bit from current levels, say
Yeah.
15% annual revenue growth, maybe 18% net income growth.
Still very strong growth for a company this size.
Absolutely. With a more moderate PE multiple, maybe 29 to 34, which seems very fair for a company of Meta's quality. The stock price projection for 2029 is between $1,600 and $1,800.
And the CAGR there?
Still fantastic, low 20% range,
Mm-hmm.
still beating the market handily.
All right, now the important one for risk management, the bear case. What if things go wrong?
This scenario assumes a pretty rough patch, like a worldwide recession hitting for a year or two, significantly slowing down global ad spending.
So even in that environment,
Even then, If Meta averages just 10% annual revenue and net income growth, which is quite low for them historically,
The stock is still projected to hit.
between $962 and $1,200 by 2029.
Okay, now that's the really interesting implication, isn't it?
It really is. Even in the worst-case scenario modeled, Meta stock is still projected to outperform the S&P 500 over the next 4 or 5 years.
With a CAGR of maybe 6% to 11%?
Exactly. That combination, massive upside potential in the bull case, strong returns in the base case, and still likely beating the market even in a bear case. That's driven by their sheer scale and profitability. It's why Meta is seen as this sort of reliable giant within the growth space. Hashtag tag tech 3.2. AMD, Advanced Micro Devices.
Okay, next tech giant, AMD. Advanced Micro Devices. Now, compared to Meta, its recent performance has been, well, relatively sleepy, wouldn't you say?
Yeah, sleepy is a good word for it in context. Up 75% over 5 years is still good in absolute terms, obviously.
But it just pales next to NVIDIA's 1,200% over the same period.
You absolutely cannot talk about AMD without talking about NVIDIA, especially now with the AI chip race.
Right. The sources were pretty clear. NVIDIA just got way out in front early on.
Yeah, the analogy used was like a 400-meter race.
Right.
NVIDIA exploded out of the blocks and had a massive lead after the first 100 meters.
Well, AMD was still kind of fumbling around, metaphorically still in the blocks.
Pretty much. But this is where the ultra-high growth story for AMD is supposed to begin, according to the sources.
The catch-up phase.
The catch-up phase. Thanks to CEO Lisa Su's leadership strategic acquisitions, focused chip development AMD is now seen as rapidly closing the gap.
We're at the point where they're finally entering the AI race seriously.
That's the argument. They're focused on their current tech, like the My 300 series and the upcoming My 350. They're finally in the game.
And we're seeing that show up in the numbers, that acceleration factor.
We are. Revenue growth went from just 2% 6 quarters ago to 31% in the most recent quarter.
Okay, that jump from low single digits to over 30%, that's exactly the kind of acceleration we talked about earlier with Palantir, the marker for potentially huge gains.
It is. But here's where the sources get really interesting, maybe even a bit controversial. They take aim at the current analyst expectations.
What are analysts projecting for AMD's growth?
Over the next 5 quarters, the consensus average is for growth between 18% and 27%.
Which sounds good, but the sources think that's way too low.
Yeah, the language used was pretty blunt. Things like analysts being clueless and their numbers being way low.
Strong words. What's the reasoning? Why would the analysts be so far off?
Well, it's not just name-calling. There's a structural argument. Analysts often build models based on historical trends, maybe conservative forecasts for enterprise IT spending.
Okay.
What the growth investors argue they're missing now is the sheer speed and scale of adoption by the hyperscalers. The Googles, the Metas, the Microsofts, the Amazons.
They're buying AMD's AI chips faster than expected.
And in larger quantities. Because these giants are desperate to diversify their supply chain. They do not want to be solely reliant on NVIDIA long term. They need a strong second source.
But hang on, isn't that just wishful thinking? AMD has sort of promised to catch up before in other areas and hasn't always delivered against NVIDIA. What makes this time different with the May 300 and My 350 chips? That feels like a big leap of faith.
It's a fair question. The argument is that this time it's different because of the specific technical capabilities in the ecosystem. The MI300 series, and presumably the 350, are designed to be highly competitive on key performance metrics for AI workloads. Things like training large models and especially inference, which is running the models.
So the hardware is genuinely competitive this time.
That's the claim. And just as importantly, their software stack, ROCm, which is the environment developers use, is apparently improving much faster now. It's becoming easier for these big customers to shift some workloads away from NVIDIA's UDA platform onto AMD's hardware.
Okay, so it's a combination of competitive hardware and a maturing software ecosystem, plus the customer's desire for a second source.
That's the thesis. So the belief among these growth investors isn't just hope. It's that growth will be at least 30% plus per quarter, maybe hitting 40% or even 50%.
As this enterprise spending shift happens much faster than analyst models predict.
Exactly. And they point directly to NVIDIA's recent history as the template. Between 2021 and 2023, analysts were consistently wildly wrong about NVIDIA.
They kept underestimating earnings by billions.
Billions. Their forecasts were just way, way behind reality. And that massive, unexpected earnings beat is precisely why NVIDIA's stock went parabolic, up 1,200%.
So the bet is AMD is positioned for a similar shock and awe performance, blowing past analyst numbers.
That's the bet. Driven by technical gains and the market's need for competition, it's definitely an aggressive call.
Okay, let's shift again into the fintech space now with SoFi. Looking at its 5-year chart, it's up 158%.
Decent return, but that number hides some truly wild swings recently.
Yeah, that's the key point. It shot up from around $6 to $28 in maybe the last year or so.
Only to pull back dramatically again. This one really tests your conviction. You absolutely need that mental fortitude we talked about earlier.
So SoFi, it's a fintech company, but also technically a bank now, right?
Yeah, they have a bank charter. But their core strategy, led by CEO Anthony Noto, is very different from traditional banks. They aim to run asset light.
Okay, we need to define asset light here. What does that mean in banking?
Good question. Think about how old school banks, like, say, Chase or Bank of America, built their empires. It was all about physical assets.
Ranches on every corner, tons of ATMs.
Exactly. Expensive real estate, huge physical infrastructure.
Yeah.
That's the old competitive battleground. How many branches do you have?
SoFi avoids that.
Largely, yes. They're asset light because they spend much less on costly physical locations and legacy systems. Instead, they plow that saved capital into technology, data analysis, building out their mobile app.
Because that's where the battle is moving.
Especially for younger generations. The new game is mobile-first banking. People want ease of use, speed, seamless digital products. They don't care as much about walking into a branch.
And SoFi is positioned well for that shift.
Exceptionally well. And they're leaning into it aggressively.
What's the key metric showing their success right now?
Member growth? It's
Yeah.
just exploding. They went from 8.7 million members about a year ago, 11.7 million in the latest report, adding millions of members in a year. That rapid customer acquisition is the fuel for their future profitability.
Right. We need to really hammer this point about customer acquisition payoff because SoFi gets the member now, but the real money comes later. Right.
Massively delayed, yes.
Yeah.
The initial sign-up bonus or getting someone to open a checking account is just the very beginning. The sources use that classic anecdote about Chase.
Paying an 18-year-old $250 just to set up direct deposit.
Exactly. Why would a giant bank pay someone to become a customer?
Because they know the lifetime value is huge.
Enormous.
Yep.
Chase knows that $250 is an investment they'll recoup many, many times over, once that kid's paycheck is flowing into Chase.
They'll probably get their first credit card there.
Then their first car loan. Eventually their mortgage, maybe investment accounts. They'll pay fees, use products for the next 10, 20, 30 years.
So apply that to SoFi. When you see them adding millions of members.
You have to understand the big financial payoff isn't immediate. It's coming a year from now, 3 years from now, maybe even 20 years from now, as those members mature financially.
As they start using SoFi for bigger things, personal loans, home loans, investing through the platform.
That's when the revenue and profit growth really starts to ramp up exponentially. It's a long game based on building relationships through the app.
What's really striking is that they're achieving this incredible member growth right now.
In what's arguably a horrible environment for lending.
Yeah, interest rates are high, economy's uncertain. Probably the worst time for personal loans, car loans, home loans in maybe 15 years.
Quite possibly. So the fact that SoFi is still growing members this fast, even now, Shows the underlying strength of their model and their brand appeal.
And it suggests that when the macro environment eventually does improve.
Right, when the Fed eventually eases up, when rates come down, when people feel more confident buying cars and houses again.
The operating environment for SoFi could become extremely favorable.
Potentially turbocharging the revenue and profit growth even further, which, again, could make today's stock price look very cheap in hindsight.
Okay, finally, let's touch on the honorable mention. Kava. This one's different, a food company.
Yeah, not tech, not finance, but its growth trajectory absolutely puts it in the ultra-high growth discussion. The simple description is Chipotle, but Mediterranean food.
And the food's good?
Highly praised, yeah. Good quality, popular concept.
And the growth numbers definitely fit the bill.
Oh, yeah. Consistent 20% plus quarterly revenue growth. We're seeing numbers like 27%, 35%, 38% reported.
What's driving that? Just opening more stores.
Primarily, yes. It's the classic fast casual rollout strategy. They've proven the concept works. They have strong average sales per restaurant. Now it's all about execution.
Just stamping out hundreds of new locations across the country over the next decade.
That's the plan. Follow the Chipotle playbook.
Okay, so if the growth is there, why is it only an honorable mention? Why isn't it one of the core picks?
One word, valuation.
Ah, back to the F1 car pricing.
Exactly. The stock is currently on the watch list for the sources, but not a preferred buy right now, purely because of valuation concerns. It's the F1 car price, but maybe without the long, proven track record of profitable scale yet.
How high are we talking?
The data point that jumps out is the forward PE ratio. It's currently sitting around 111.
111. Okay, that is very, very high.
Extremely high. Now, theoretically, an ultra-high growth company can grow into that kind of valuation over many years, eventually making today's price look reasonable.
But the risk?
The risk is acute. A PE like that leaves absolutely zero room for error. None.
So if that growth rate slips, even for just a couple of quarters, maybe they run into staffing problems trying to expand too fast, or maybe the Mediterranean food trend cools off a bit.
The stock could get absolutely crushed. Significant downside potential. Kava already had a big drop from its peak over $100.
But another volatility shock could take it way lower, down to $30 or $40.
It's certainly possible with that kind of valuation. The air is very thin up there.
This high valuation risk leads to a useful comparison the sources made. Kava versus a safer alternative like Cake.
Right. Cake is the parent company of the Cheesecake Factory, but also owns North Italia and Flower Child, other successful concepts.
So Cake is much less risky.
Far less risky from a valuation perspective. Trading at a forward PE of maybe 15 or even 12, depending on the estimate, and it's diversified across several proven brands. It's a solid, well-run company.
But the trade-off is growth.
That's the trade-off. Cake's expected growth is much slower, around 7% next year, maybe. Good, stable, but definitely not ultra-high growth.
So this choice, Kava versus Cake, perfectly encapsulates that investor dilemma we talked about earlier.
It really does. The F1 car versus the Honda Civic. Do you chase Kava's potentially explosive growth, but accept the huge downside risk if they stumble even slightly?
Or do you opt for the safer, diversified, slower-growing stability of something like Cake?
Your personal risk tolerance, your temperament, really dictates which path makes sense for you. Hashtag tag outro.
So wrapping this all up, this deep dive really paints a clear picture of the two sides of the ultra-high growth coin, doesn't it?
It absolutely does. On one side, you have that massive, almost unbelievable potential reward.
The 2,000% gain from Palantir, the 31,000% return from NVIDIA, the kind of results that can truly change your financial life, maybe even impact future generations.
But that potential is welded, completely fused, to the mandatory mental requirement on the other side.
Preparation for volatility.
You have to be ready for those gut-wrenching 30%, 40%, 50% drops. If you're not, the market will treat you exactly like that ant on the waterfall.
It'll throw you out right at the point of maximum pain, maximum pessimism.
Already time.
Looking across the 5 companies we profiled today, plus Kava, we saw some common themes emerge, didn't we? Even though they're in totally different industries.
Yeah, definitely. Strategic acquisitions were a big driver for Celsius, for ELF, and historically for Meta, buying growth or capability.
Then there was that aggressive, forward-looking investment, spending big today based on confidence in the future. That was key for Meta's CapEx and AMD's R&D push.
hmm And then capitalizing on big shifts in consumer behavior, whether that's ELF leveraging social media and pricing, Celsius tapping into fitness culture and distribution, or SoFi riding the wave of mobile-first banking.
So let's leave our listener with that final provocative thought to chew on. We've talked a lot about numbers and strategies, but so much of this comes down to psychology.
It really does. The journey of building wealth is often more about managing your own emotions and temperament than just picking the right stock.
So reflect seriously on that choice we highlighted, the F1 car strategy versus the Honda Civic strategy.
High growth, high risk, high volatility like Kava or maybe AMD right now versus the safer, slower, more predictable path of a company like Cake.
Which approach truly matches your personal temperament? Your ability to sleep at night when things get rocky.
And remember that meta bear case analysis.
Yeah.
Even if the worst happens, some of these giants might still beat the market. Where do you personally draw the line between chasing maximum potential reward and demanding a certain level of mental comfort, of endurance?
Understanding yourself, your own risk tolerance, is arguably just as important as understanding the balance sheets of these companies.
Well said.
Well, thank you for joining us for this deep dive into the exhilarating and sometimes terrifying world of ultra high growth stocks.
We really hope the insights and frameworks we discussed today help you navigate this landscape, whatever your approach it might be.
We'll see you next time on the Motivated Mind Zone.